So what we haven't talked about yet is that the cost of issuing new common stock is more expensive than just relying on retained earnings. So remember back in the beginning I said we had those two choices with common equity. You could either rely on retained earnings or issue new common stock. Well, if you have to issue new common stock, that means your capital budget was not large enough. Um, you didn't have enough money to fund all your capital budgeting projects. So, and for issuing new common stock, there are flotation costs, and they can be large, like 15% to 20%. And so, since that's such a large percentage of the issuance, it's something we have to account for in a calculation. So the company is raising money in order to make an investment. The money has a cost, and this cost is based primarily on the investor's required rate of return, considering risk and their other investment choices. So the new investment must provide a return at least equal to the investor's opportunity cost. So for a different way to say this, if the company raises capital by selling stock, the company doesn't receive all of the money that investors contribute, like we were talking about. For example, if investors put up $100,000 and if they expect a 15% return on that $100,000, then $15,000 of profits must be generated. But if flotation costs for that $100,000 was 20%, which would be $20,000, then the company will only receive $80,000 of the $100,000 that investors contributed. Then they have to take that, the company has to take that $80,000 and then produce a $15,000 profit, which if you said 15,000 divided by 80,000, you would get 18.75% rate of return that they would now have to produce versus a 15% return on equity that would just have been used by relying on retained earnings. So two approaches for flotation costs. The first approach is to include the flotation costs as part of the project's upfront cost, and that would reduce the project's estimated return. The second approach is to adjust the cost of capital to include flotation costs, and this is most commonly done by incorporating flotation costs in the discounted cash flow model. And that's the way that we will use in this chapter. So the modified cost of issuing new common stock equation is where you have D1, and it used to be over just P0 with if we were just relying on retained earnings, but now we have P0 times 1 minus the flotation cost percentage and then plus G. So the only extra thing that we've added here is this 1 minus flotation costs. So if we use the information that we had before, we had the D0 was $4.19 times 1.05, the growth rate. And then now we'll have $50 in the denominator times 1 minus the flotation cost of 15%. And then we add 5%. So you can see that the cost of issuing new common stock is much higher than the cost of relying on retained earnings. We get 15.4% here, where I believe we got 14.8% using if we just relied on retained earnings. And so that's really it's a pretty simple adjustment. Just add this times 1 minus flotation percentage. So although we've talked about the flotation costs and how it could vary based on the riskiness of the firm, and we really only consider the flotation costs for common equity out of the three components of the weighted average cost of capital. And then pretty much we ignore the flotation costs with the other two, the debt, and then really and for preferred stock. It's not really a big deal what this slide is saying here.